Welcome to this video, where we'll take a detailed look at 3 candle patterns in technical analysis. In our previous video, we covered the anatomy of a candlestick, as well as classic single candle and 2 candle patterns. If you haven't watched it yet, make sure to check it out by clicking the link in the top right corner. These foundational concepts are essential to fully understand the patterns we'll discuss today. 3 candle patterns are widely used by traders to identify potential reversals, continuations, and momentum shifts in the market. Mastering them can significantly enhance your ability to time entries and exits more effectively. Let's dive in. Number 1. 3 white soldiers. This bullish continuation pattern consists of 3 consecutive long bullish candles, each with higher highs and higher closes. It signals strong buying momentum and the potential start of a sustained uptrend. The 3 white soldiers pattern often forms after a downtrend or a period of consolidation, suggesting that buyers have taken control of the market. This bullish continuation pattern reflects strong upward momentum. For additional confirmation, ensure the candles form near a key support level, and watch for steady or rising trading volume, which adds credibility to the signal. Number 2. 3 black crows. This bearish continuation pattern comprises 3 consecutive long bearish candles, with lower highs and lower lows, indicating strong selling pressure and the likelihood of a continued downtrend. The 3 black crows pattern usually appears at the end of an uptrend or a consolidation phase, signaling that sellers have seized control. This bearish continuation pattern indicates sustained downward momentum. To confirm its validity, look for increased trading volume during the formation of the candles, as this strengthens the likelihood of a continued downtrend. Number 3. Morning star pattern. It is a classic bullish reversal pattern that signals a potential trend change from bearish to bullish. It consists of: first candle, a long bearish candle that shows strong selling pressure. Second candle, a smaller candle, either bullish or bearish, with a narrow range, indicating indecision or weakening momentum. Third candle, a strong bullish candle that closes above the midpoint of the first candle. The morning star typically appears at the end of a downtrend, suggesting that buyers are regaining control. For added confirmation, look for increased trading volume during the third candle. Number 4. Evening star. The evening star is the bearish counterpart of the morning star. It appears at the end of an uptrend and consists of: first candle, a long bullish candle showing strong buying momentum. Second candle, a smaller candle with a narrow range, signaling hesitation. Third candle, a bearish candle that closes below the midpoint of the first candle, confirming a potential downtrend. The evening star typically appears at the end of an uptrend, signaling that sellers are starting to gain control. This bearish reversal pattern highlights a shift in market sentiment from bullish to bearish. For added confirmation, look for increased trading volume during the third candle, as this indicates strong selling pressure. 3 candle patterns are a valuable addition to any trader's toolkit. They combine short-term price action with broader market psychology, helping you anticipate shifts in market direction. However, always remember that no pattern is foolproof. Use them as part of a broader strategy. Thank you for watching. If you found this video helpful, please like, comment, and subscribe for more trading tips and insights. See you in the next video.